Okay, let's dive into a topic that, either gets people super excited or honestly a little bit scared: the stock market. We hear about it all the time, but what's really going on behind the curtain?
When you say stock market, people's minds usually jump to one of two places. It's either stories of making a fortune overnight, the whole big money dream, or it's the nightmare scenario of losing everything in a flash. It's always these two extremes, right? Huge wins or massive losses. But hang on. Before we get lost in all that drama, we need to take a step back and ask the most fundamental question of all, the one that everything else is built on. What are we even talking about here? What exactly is a share?
Well, it's actually way simpler than you might think. A share is just a small piece of ownership in a company. That's it. It's not some mystical financial instrument, it's literally just owning a tiny slice of a business.
Yeah, you heard that right. The second you buy even one share, you're not just a customer anymore. You're a part owner. You own a little piece of everything: their buildings, their brand, their future profits. You're on the team now. To really make this stick, let's cook up a simple imaginary company. We'll just call it ABC Limited. So let's say our company, ABC Limited, is worth a total of 1 crore rupees. That's its entire value. Now, that's a huge number, right? Not exactly something one person can just go out and buy. So here's the clever part. To raise money, the company takes its total value, that whole 1 crore, and slices it up into thousands of tiny, equal pieces. In our example, they slice it into 100,000 pieces. And guess what? Each one of those little slices is 1 share.
So, what does that mean for you? Well, it means if you go out and buy 10 shares, you literally own 10 of those 100,000 pieces of ABC Limited. Your ownership is real, and it's directly tied to how many of those little slices you have. Okay, but that brings up a really good question, doesn't it? Why on earth would a company want to sell off little bits of itself to complete strangers? What's the catch?
It all comes down to one word: growth. Selling shares is how companies raise cash. It's fuel for their ambitions. They use that money for the big stuff: expanding the business, building new factories, or just funding their next big move. They get the cash they need, and you get a piece of the action.
All right, so that makes sense from the company's perspective. But let's flip it back to you. You've bought your piece of the company. How does that actually turn into more money in your pocket? There are really two main ways you can make a profit. The first one is what everyone thinks of: price appreciation. Buy low, sell high. Simple as that. The second way is something called dividends. This is when the company does really well and decides to share some of its profits directly with its owners, which now includes you. Let's just look at that first one, price appreciation, real quick. It's super straightforward. Say you buy 1 share of ABC Limited for 100 rupees. Now the company does great, people get excited, and the price of that share goes up to 150 rupees. If you sell it, boom, you just made a 50 rupee profit. But, of course, that's the big question, isn't it? What's this invisible force that pushes the price from 100 up to 150, or sometimes down to 50? Why don't they just sit still? It all boils down to the most basic rule in economics: supply and demand. If the company is doing well and a ton of people want to buy its shares, that high demand pushes the price up. On the flip side, if something bad happens and everyone's trying to sell their shares, that high supply of sellers drives the price right down. Now, people tend to approach this whole dance of prices in two different ways. You've got the investor, who's in it for the long haul. They believe in the company and plan to hold on for years. Then you have the trader, who's more of a sprinter, trying to make quick profits off those short-term up and down swings. And that difference between investing and trading, well, it leads us to a really, really important warning. Here's the deal. Jumping into trading without knowing what you're doing can be seriously harmful to your wallet. You have to understand the game you're playing. Knowledge comes first, always.
And that's because, and this is so important, the stock market is not a casino. It's not about making a lucky guess. It's about making informed decisions based on real information and a solid strategy. So let's bring it all back to where we started. When you strip away all the noise and the jargon, what are we left with? Just a simple, powerful idea. A share is simply a piece of a company.
And once you really get that, once you start to approach it with the right knowledge, it stops being this big, scary thing. Instead, it can become an incredibly powerful tool for building wealth over your lifetime.
So, I'll leave you with this question to chew on. Now that you know a share just means ownership, it kind of changes how you look at the brands you use every day, right?
So, what's the first company you can think of that you'd actually want to own a piece of?